Welcome back to Monday Returns. This is where I go through ETF performance over the last week, and obviously last week was a rough week. The markets overall were down across the board. S&P, energy, Russell, NASDAQ, whatever you want to talk about, they were all down big time. Obviously, a lot of ETFs were down on the week as well. Plenty to choose from on the downside. There were some positives in the ETF world. Anything that was dollar bullish did well. Anything that had interest rates or followed interest rates, very thematic or very based on that. We also had a very good week. And then BDRY, which is a shipping ETF that is a high earner and then a decliner week to week. So this week was a good week for them. And then CYA is at the top. That is actually a fund that led the week last week, and we'll jump into that one a little bit later. On the downside, as I mentioned, energy had a rough week. So a lot of these are energy-based, natural gas, hydrogen, oil services. Cannabis was also a couple of cannabis funds in there, small cap energy, oil and gas. And then, of course, PBUG. Again, that is that fund that tries to balance the act between treasuries and gold. Week to week, it can be really high or really low. And this week was a bad week for PBUG, down 16% on the week. So as I said, let's jump into CYA, kind of get a feel of what is this fund and why is it performing in markets like we are experiencing right now, or at least the last couple of weeks. So again, over the last month, you can see this fund has jumped up from negative to positive, and then last week was a really good week for them. Again, this fund hasn't been around a whole long since September of last year. Over that time, it is still down a hair, but as you can see, it's really bounced back over these last couple of weeks as the markets have gone south. So what is in CYA? This is a fund of funds. So Simplify is a company, and they have some other funds that they put inside of this fund. A volatility fund. This is a fund that was based on the S&P 500 volatility. This is over a third of the fund. A high yield credit hedge is 30%. A treasury type fund. Again, another one that's kind of a hedge type fund is 22%. Interest rate hedge is 11%, and then they actually have a bond ag that's a hedge version that is right over 1%. So if you kind of jump into these funds, it's interesting. So SVOL, again, a simplified fund, but it's actually a ProShares fund that they've kind of repackaged. And so this is, again, a S&P short-term volatility play. Over the last year, it is done better than the S&P has. So, but again, it's just following the volatility, not necessarily the performance. CDX was another one that was in there. Again, this is another fund that is not theirs. iShares iBox is a good portion of this fund. Now, this is a strange day-to-day hedge fund, so they have all kinds of holdings, and day-to-day, sometimes their holdings don't actually match up. The other one that was within this one is a treasury fund. Again, over the last year, it's done horribly, down 36%. Again, hedge versus the treasury at the 7-10-year treasury. Again, all these simplified funds are fairly new. And then PFIX, another one of their funds, this is an interest rate hedged. Again, these types of funds this week actually did well as rates were announced to go up and probably continue to go up. These funds may do well over time. As you can see, again, another one that's only been around for a little over a year and hasn't done very well until really the interest rates started to peak this year. And again, it follows those rates. So it's done pretty well this year. So that kind of gives you an idea of what is in CYA and why it's doing well. Again, it's just based on those interest rates going up. It's in volatility. So that's been a good mix, especially over this last 2 weeks. So that's why it's done well. Anyway, so I hope this has been insightful. We'll talk to you next week. Have a great day.